Thank you very much for coming here. It's a great honor to present. Coase invited me to give a talk here to talk about some of my research. I also have to admit that, Coase, could you please leave the room for a moment? that this is more like I give my seminars and less like a tutorial session. Although I think I'm trying to give my seminars also like one would be tutorial sessions. I hope to communicate everything. Feel free to interrupt me. I really want to make this an interactive seminar, and I will call on you if you doze off. That was my attempt at a joke. They did an internet kind of survey to try and figure out what nationality is considered funny. I'm originally from Germany, so they gave different kinds of jokes, and then they asked them, how funny do you think this is? And the problem with the Germans is they found everything fun to be funny. So I have a little bit of that, so it's hard for me to figure out what's actually funny and what's not funny, so don't take it personal, please. I'm going to try and challenge some of your perceptions. I'm going to try and provoke you a little bit. I'm going to go a little bit further in the seminar than I go in the paper. So the paper is trying to be more civil than this seminar. And hopefully you're going to remember this seminar rather than the normal one where you do doze off too easily. So here's my short take on economic history. So we've had lots of progress over the last 50 years. Positive economics began about 50 years ago, where Friedman basically said, well, we build models to explain a particular phenomenon, empirical phenomenon, in a particular context. And even if the model isn't perfect, it's got some weird aspects to it, as long as it predicts really well, we're fine with it. Of course, the irony here is it's a normative paper itself. It's about how you should do economics rather than how we actually do economics. Before Friedman, of course, lots of economists wrote more about normative economics than we do today. In 1976, Lucas came along and basically said, well, yeah, but all these models that are reduced form that you're using to forecast a variety of different things don't really work that well. You can't use them for policy evaluation. They come from reduced forms. You change underlying variables, and the relationships are no longer stable. So if you want to have a model that's really stable in predicting, you need something that's built on deeper foundation. It's not going to fit as well in sample as something that's an ensemble regression, but presumably looking forward, it predicts better than these ensemble regressions. I should add that came at a time when all these macroeconomic forecasting models all of a sudden no longer worked that well during the time of stagflation. So they were really concerned with the stuff fits really, really well in sample, but if you do it out of sample, it fits miserably. And that's won the war. That's clearly won the war. We all understand that reduced form models have structural instability. A couple of years later, 10 years later, Mera and Prescott came along with a great, great paper which said, well, these models are all nice and good, but we have to have at least some idea of what the magnitude of this stuff is. So yes, it's okay if we have a comparative static that says as people become more risk averse, then the equity premium goes up. But if it's not the same if it goes up by 0.01% per year, or if it goes up by 5% per year, if your risk aversion changes a little bit. So we have to pay more attention to these models. And when you do this, you actually figure out, and there's been so much follow-up work, you're all familiar with it, that the basic model without any tweaking cannot explain why we observed an equity premium that at the time stood about 8% per year, 7% per year at that time. Okay, big break, time and area. Just a few years ago, I think we actually are entering a new paradigm. Yes, is that a question?
No.
I know, I was
Not yet. I know you were joking.
Thank you. So I think we're now living in a new paradigm where we're thinking much more closely about identification, which basically means we're thinking about what can reasonably consider to be an exogenous variable and what is reasonably driven by it. And I am the first to blame. I've been in this profession for about 20 years now. Coase, 25? So we all wrote papers where we basically said we have a beautiful theory, and In this theory, for some reason or another, X correlates with Y. So let's just regress the two on one another. If the correlation is statistically significantly positive, we declare victory in favor of the theory. But really, in the real world, X is not necessarily the exogenous variable. So particularly when you do corporate finance, what you get is you very often regressing things that look endogenous on other things that look endogenous. And it's really hard to understand something from that. And what Angris and Pischke basically said, well, let's focus more on situations where we can identify something that looks reasonably like an exogenous shock, where we really know that X is something that changes for an unexpected reason, and then see what happens to Y. And of course, we've just had a Nobel Prize with Sims for causality. That's a weaker form of causality. The original Granger-Sims causality is, well, you look at things that, so you have a particular time series in X, you have a particular time series in Y, and it can be cyclical and other things. And what you're looking for is when X suddenly has a sharp spike for some reason or another, you try and figure out whether in time you get a sharp spike afterwards in Y. Okay, so we just had a beautiful Nobel Prize. What this quasi-experimental stuff does, in some sense, is it says, well, do you have a good explanation why we get this sharp spike in X? So can we think a priori why you would see a particular spike in X here that comes for an exogenous reason, and then look for a change in Y? So in my view, it's taking this Granger-Sims causality stuff further than Sims itself. Okay. What I'm not going to cover in this is lots of other things that are about models. Modeling is both an art and a science. Let's not kid ourselves. We're not like philosophy or math, where we sit around in our cellars, or in NYU's case, in beautiful high-rise, or Yosh, the other places, and we come up with theories. No, that's not how it is. So we sit around and we wonder, is this a model that we find aesthetic? And for many people, aesthetic over many years meant rational expectations. Now we are a bit more relaxed in finance. We allow some behavioral abnormalities, but there is an aspect to what models do we consider pleasing or not, and there's an aspect of taste to this. It's not just science. So I may find a model beautiful, my own model, of course, and find Coase's model not so beautiful. Joke. Joke. Okay. So what's top-notch economics? So as a professional, I'm sitting in a lot of seminars. We often like to pretend we are harder on the science than we actually are. So we have this physics envy sometimes. So where it's so beautiful to see these models which come together, and we can show you how we can handle this, and we can handle diffusion processes and other things. And it's very impressive, but I'm going to argue that some of this actually is an emperor without clothes, not all of it. We like tight models and tight predictions, so get these functional relations, and we can actually estimate them on data, and we're thrilled when that happens. We can show off how complex the models are that we can handle. Well, many of you are either interviewing for a job or interviewing somebody else for a job, and clearly when I sit in with my colleagues, one of the things that we always judge is this guy smart? And strangely enough, we don't do what we really should do, although we sometimes do, which is, well, smartness is not ability to manipulate algebra. Those are two very, very different things. But clearly, we often use the ability of our recruits to solve very hard problems as an indicator of smartness. So structural modeling that we do here is a great way for it. So if you're a PhD student who in 2 or 3 years will be on the market, ignore everything negative that I say about structural models. This is a really great way to show off how brilliant you are manipulating algebra. So I'm going to ask how well dressed is the emperor. In some cases, very well. I'm going to argue some of this very high-tech structural estimation is great, and some of it is not so great. And I'm going to talk about a specific research area, corporate finance. I'm going to describe the challenges, but the same issues arise in all sorts of other disciplines. Corporate finance is easier for me to discuss because I, of course, have worked in the area for more years, but it's the same in other areas. I'm going to look at the current top models in the area. I'm going to look at a top quantitative model and at the top structural models. And I'm picking them because they're really, really good. Okay? I'm not picking them because I think they're easy to shoot at or they're bad. I'm picking them because they're really good. And they're still going to have a lot of trouble. Now, at the end, what you're going to say, well, you've convinced us that these models are not so good as you claim they are. And I'm going to claim they are really good models. But in the future, I'm going to write a model that's going to have none of these weaknesses of what you describe. And if you can do this, I'd love to see it. I'd be thrilled. Structural models, if they actually work, if they worked well in terms of predicting, in the Friedman and quasi-experimental sense, would be much better than the silly sketch models that I often do. It would be much, much better. However, if they don't, then I'm going to argue they're not that useful. And I haven't seen a model, any structural model, in any context except in arbitrage-determined context, which work really well. And I'm going to explain that later. So I agree, where are the good models? I personally think that the task is too difficult, and for those of you who are much younger than me, the next generation, I hope you're going to prove me wrong and write much better models. Okay, corporate finance, I'm going to structure this roughly into capital structure, which is financing and payout, capital budgeting, which is project choice, and corporate governance. We have a lot of research on here, a lot of research on here. Interesting enough, there isn't that much research here, but these are the rough areas of corporate finance. The research challenges in corporate finance abound. Some are standard, some are unusual. I'm going to focus on this one, but again, it extends much further. So here are some of the problems that we deal with in corporate finance. We have many different priors. So if you ask me what corporations do, and you ask Jeff Wergler what corporations do, and you ask, I'm going to pick somebody, Merton Miller or Ilya Strulayev, they have very, very different priors on how rational corporations actually behave. So that's going to lead to many different theories. There's many variables that look endogenous. I mean, at some level, everything except sunshine is more or less endogenous. And that's not even true, because we have global warming and we can change that too to some extent. So even that is not fully exogenous. But it's a matter of degree. So a lot of stuff in finance, a lot of the variables we use in CompuStat is not really clearly exogenous. We have very murky evidence. So when you run regression, this is systematically true. It's also in my work. So I'm critiquing my own work here just as well. Lots of findings are really specification dependent. You tinker around with them, and there's no reason to tinker one way or the other, and they change. The t-statistic goes from 3 to 2, or from 3 to 4, or from 2.2 to 1.6. Now, of course, when you send something to the journal and it says 1.6, that's bad news. And actually, I would argue this is a rat race, because if it's 1.6, you probably tried everything in your power to make it come out to be 2. That means it's more between 0.8 and 1.6. But if 1.6 is sort of the lower bound of where you sit with different specifications, that's actually pretty good and a pretty robust finding. Typically, it's also sample dependent. And we use different samples in different years. Sometimes we exclude utilities, sometimes we exclude financials. We do different kind of things. Typically, our questions explain only a small fraction of the variance. So I have a theory that says that cash predicts capital structure. And I get a t-statistic of 6. And I declare victory. But 6 in many contexts can mean an R-square of 1%. Remember, we have thousands and thousands of observations. Okay? So in the end, we may just explain a small fraction of the variance of what's actually going on here. There's few or no arbitrage constraints. So if a particular firm screws up on its capital structure, it should have an optimal debt ratio of 25%, but it right now has an actual debt ratio of 10%. There's nothing you can do as an outsider. I mean, any models that I know of capital structure have very flat surfaces in terms of what the value impact is of being away from the optimal value. And it's just not worth it to take over the company, fire the manager, and set the right capital structure, and then turn around. Dividends, same thing, you know. If you have the wrong dividend policy, there's just not much one can do. So mistakes can actually persist. So corporate finance is a much more fruitful area for behavioral finance than, say, asset pricing. Because in asset pricing, if something is really wrong, you can make money off it. It's hard to make money of it, but at least in principle it's possible. Here, forget it. We have a large cross-section. We have thousands and thousands of firms, but our time series is usually just annual. Quarterly data is a nightmare to work with. It's got seasonalities. And the fact of the matter is we have like 40 years worth of relevant data, maybe 60. For the most part, we don't have that many different observations that many years. We have huge selection and survivorship biases. Okay, let me ask you. So now I can pick somebody random in the audience and see who pays attention. The typical firm on CRISP and CompuStat, how long is it alive? The median firm, median time to exit.
20 years.
20 years? 10 years. About 10 years. It's a very good guess. So in particular, if you're interested in some of these papers that do long-run capital structure, that are trying to do 5 to 10 years, half the firms are gone after 10 years. Okay, so I read these papers, and many of them are not doing a great job with survivorship bias and selection biases. This is something that's really problematic for us when we use CRISP and CompuStat data. We don't have a clue usually why size matters, but it matters. So we all stick size into these regressions. We don't really know. Do we throw out the baby with the bathwater? Yeah, I don't know. We stick in industry effects. We stick in time dummies. We don't know. We have proxy issues. So many of our theory says what matters should be marginal Q. How in the world do you measure marginal Q? We can't measure marginal Q. We measure average Q. Okay, so tough issues. But we have one huge advantage in this area, and it hasn't been exploited enough. There are wonderful quasi-experiments that happen all the time in corporate finance, which from the perspective of the firm, we can reasonably consider to be exogenous. So yes, tax code changes, in some sense are endogenous too, but that's when you do a study of Congress. When you study individual firms from the perspective of an individual firm, tax code changes are probably mostly exogenous, at least when it comes to non-specific earmark kind of weird things. So the generic corporate income tax. Bankruptcy costs. Okay, so we had a couple of years ago, all of a sudden prepackaged bankruptcies came online. Okay, before that, you went into bankruptcy, it took 4 years. Suddenly there's a shock. You can now do a bankruptcy in 3 months. Okay? That's exogenous from the perspective of most shocks. And if you believe in theories in which bankruptcy cost matters, that should be, because it influences something else, that's a great quasi-experiment to exploit. Productivity shocks. So if you have FedEx delivered today to your office, you sign something that's electronic, you can track it online, the guys know exactly where their drivers are. It wasn't like that 20 years ago. So you have industry heterogeneous shocks to productivity. If you have a theory in which productivity actually influences something else, yeah, unfortunately you can't easily do it for the whole economy, but you know when FedEx introduced its various electronic systems, you know when human genomes sampling techniques came online, you can measure this within individual industries. Resource cost changes. Vastly underdone. For most corporations, the price of oil is exogenous. Why don't we exploit this more often in corporate finance? Now, there is a great seminal paper by Owen Lamont which does exactly that, looking at what happens to companies that have both oil divisions and pharmaceutical divisions, and when the oil price rises, what do they do in their pharmaceutical divisions? It's a beautiful paper, and it's way before we actually called it quasi-experiment, but it's stunning. I mean, it's just a great paper. But this hasn't been exploited enough. We have exchange rate changes. Who in the world does something with, how do exchange rate changes actually matter? Now, that's effort because you have to figure out who do you sell your products to, who do you buy your stuff to, so you can figure out what the shock actually does to you. But there's great papers to be written, so it's wonderful to be an assistant professor right now. We have a paradigm shift. It's wonderful. Guys, the financial crisis was made for our assistant professors. Okay? It will give us natural experiments in terms of capital constraintness for years to come. There's a great paper by Almeida and 4 other people that actually will come out in a new journal in January, of which I'm the editor. Am I allowed to advertise a little bit? Okay. But it's wonderful because what it does is it actually looks at firms which had to finance right after and firms which had to finance right before the financial crisis hit in terms of their obligations. Absolutely terrific. So it's an exciting time to be a new professor in finance, or any professor in finance. Okay, so I'm going to focus on one sub-area to animate the arguments, which is capital structure, and that's about how firms' leverage ratios come about. Okay, I've already said this. I'm going to critique specific models in order to animate my argument. Okay, so here are the various theories that I found in the literature on capital structure. What are possible causes for why firms have more leverage or why firms have less leverage? Can you see there in the back? That's the point. Okay? There's a whole lot of these theories that are amazing. So I'm going to read it. Distress costs. Robichek Myers. Stu Myers. People don't today. Okay, I'm going to digress. This is fun. People today remember Stu Myers primarily for the pecking order. He was also the first guy who wrote down the trade-off theory. Robichek Myers, 1966, was the first trade-off paper. Talked about taxes on the one hand, corporate taxes, and bankruptcy costs on the other. Covenant violations, Robinson Sufi. Taxes, Graham's work. Frictions, Fisher, Heinkel, Zeitman. Adverse selection, that is the pecking order. Risk shifting, unmitigated agency concern. ESOPs, clientele's credit ratings, tangibility, stock returns, market timing. Consensus concerns, acquisitions, industry peers, pension liabilities, projects which you actually need to fund. Managerial identity, crowding out by governments, pre-commitments, hubris, investment banking conflict, or just plain non-optimal behavior. This is not exhaustive or exclusive, okay? Most of these papers also give you some empirical evidence, so it's not like one can dig up things that are at least mildly supportive. So, what can we do as economists? The first thing is we can include all the forces and let the data sort out which of these forces are important. Or we can select a subset of forces, pray that they are the right ones, and hope that all the omitted forces are orthogonal. We almost always choose choice number 2 because choice number 1 is just way too difficult. And it's not clear whether it's actually the right way to do it either. There's some reasons that you may introduce more noise, but for practical reason, you can't replicate 20 papers in order to write 1 paper. You come up for tenure and you can say, I've published 1 paper, but it really did all those 20 papers combined. Doesn't help. So, issues that we have to deal with, other than which theory do we choose, which was the previous slide, firm size, industry, time effects, missing data, they're often non-random, they die out, how will we scale, everything is endogenous, everything is highly correlated. Now, if I do a reduced form regression, at least I can run some residual diagnostics. That's fairly easy. Are my residuals seemingly okay? I can throw in more controls. It's very cheap when you do linear regressions. Throwing on all time dummies and industry dummies and cross dummies, I can do that. That's very easy in a reduced form model. Oh, and you can run it in differences. That's usually very effective, much more effective than in levels. How can we test this stuff? Well, we can do in-sample evidence. So we just run an in-sample regression. That's great if you know you got the right model. It sucks when you don't know whether you have the right model. It's also great for a quick assessment of what variables correlate highly, what matters a lot. And I have to warn you, if you do leverage statistics, leverage ratios are truncated at 0 and 1. Okay? If you are at 0, you can't have randomly distributed shocks anymore. You can't have mean zero shocks. Lots of papers in this literature are actually wrong because they assume exactly that. I've seen myself in some of this. So in general, the way that I try to do things, I try to do a lot more placebo studies. So I think about how would the world look like if things were totally random, and then whatever I want to publish, I just run on a randomly generated data set that's feasible. So for the leverage capital structure, I generate something where the leverage ratio sits between 0 and 1. And I actually have a process that I've written out, but in general, that's very, very good practice. Okay, for anything that you might do. Create a random data set and see whether your methods work. What if the model isn't correct? Now what? Well, you can do out-of-sample evidence. You can do indifferences evidence. That's sort of like the Granger-Sims causality. You see whether changes in one variable impact changes in another variable. And that's much, much better already. And quasi-experiments, which is sort of unusual, identified differences. So it's, as I noted, an extension of this. How much time do I have? A full hour. Okay. Do you guys all know about continuity tests? Discontinuity tests? Okay. Who does not know about discontinuity tests? Okay. This is something that I just want to explain for 2 minutes because it's one of the most powerful and beautiful techniques that I know. Let's presume, and I'm going to give I'm going to give an example from finance. Okay, one of my PhD students from a couple of years ago is now at Penn State, Peter Ilya, wrote a beautiful paper where he exploited the following thing. When Sarbanes-Oxley was initiated, the rule actually says that you are not subject to it unless your market value is at least, I'm going to make up this number because I don't remember it, $200 million. Anybody know the right number? Is
75.
Pardon?
75.
75. Okay, unless it's exactly $75 million. Okay? So what can you do? You can take a look at what happened when Sarbanes-Oxley started to take effect, and you take a look only at firms that had a market cap of 74.98 and firms that had a market cap of 80.02. And any difference in how much their audit costs are or how much their earnings manipulation is or any of this, it's very hard to believe that that would not be due to Sarbanes-Oxley. Similarly, you can repeat this experiment and do it instead at 75 at 85. Okay? That should have nothing to do with Sarbanes-Oxley. That's the placebo in this case. You can adjust for firms trying to push their value down to below 75. It allows you to answer lots of interesting questions. My favorite one, now I'm going to go out of finance. So we were wondering about, does prison make criminals or are these criminals to begin with? That's a really, really hard question. Okay, and there's been tons of stuff written on it with correlation. So get this. The Department of Correction actually assigns a mechanical score to each person who's convicted to decide what kind of prison you go to, whether you go to a low security or to a medium security prison. And there's like 10 different things that go into these, and there's some people that are literally just at the margin. Okay, so it's either a score of 79.3, which gets you into one kind of jail, and 79.4 that gets you into the other kind of jail. And the plausible assumption is there's no difference between a guy who has a 79.3 score and a 79.4 score. And if you're worried about this, try some other scores, like 80.3 and 80.4. And then you can actually check, do the guys who were just at 79.4, are they more likely to commit crimes in the future than the guys who had 79.3? And that is all attributable to the jail. So if you have a really good regression discontinuity study, it's almost like a causality test. It's brilliant. It's absolutely brilliant. And if you think about it, there's lots of things that go into this. When you're 18, all of a sudden you are eligible for adult offender status. When the SEC enacts certain rules, sometimes they just exclude one kind of firms and not another type of firm. So once you know about how to do these kinds of studies, you go around and you think to yourself, I've got this beautiful hammer now. Where is the name? There's a lot of truth to that. I was at Brown for many years, and we interviewed a labor economist. And I asked him, what do you do for a living? What what do you study? And he says, I'm a regression discontinuity guy. But that's what he does, and it gives you beautiful evidence. Okay, so if you have a good experiment, with my favorite being the regression discontinuity is a natural experiment, it's almost a direct causality test. Other things are like diff and instrumental variables. Instrumental variables is the weakest form thereof, and there can be a lot of argument. Is this really exogenous? Is it not exogenous? And most people that use instrumental variables techniques believe it's a procedure name in Stata. Okay? It's not. I was in an econ department for 5 years, and so it's I would advise you to do that for a year, not for 5 years like I did, but for 1 year it's very interesting because their conversations are very different. They're very good at some things and very bad at other things. But one of the things, so you have a seminar, an empirical seminar, and it's about an instrumental variables approach to solving question X, and literally you spend 3/4 of the time arguing about how exogenous the variables are that you identify through your IV. Literally. And it's obviously not as convincing as the natural experiments. Okay. The problem, by the way, with natural experiments is exactly what I just said. You walk around with a hammer and you're looking for nails. There's some questions which are just very hard to address because there aren't nails but screws. And okay, so capital structure, quasi-experiment. Taxes have changed, transaction costs have changed, financial distress costs have changed, productivity has changed, personnel can die. Steve Jobs just died. Financial crisis selectively reduced access to capital. So we have lots of great quasi-experimental tests, and that would be sort of the gold standard in testing corporate finance. Am I boring you? Feel free to ask questions. So, okay. So how good is this approach of structural modeling corporate finance? There's a lot of evidence that it seems to have an increasing market share. It won many awards, Brattle prizes. It's actually become almost a dominant paradigm in asset pricing. Certainly on the tech side of asset pricing, they all do structural models. And by the way, they all suck. That's not true. Everything that tries to predict equity sucks in terms of its predictive power. Okay, not fixed income, not derivatives, but for equity, they all suck. But nevertheless, that's all they do. They do structural estimations. Yes?
Very ignorant in the corporate. So in the beginning you said that we have this sluggish in the behavior of the corporations, or behavioral mistakes, and all these things which make it delay in response. If that's the factor of corporations, then is discontinuity a helpful tool? Because although we have discontinuity, maybe the people on two sides of the line, they don't react much to that, so we don't get much like
That's absolutely right. So there's two responses that I can have to this. The first one is very pragmatic. If I have a theory that X causes Y, so X happens, and the CFOs are all asleep and they don't do Y, then I would say my theory is rejected. Because even though they should do Y, they don't do Y. And the other is maybe they do Y eventually, in which case it just makes the regression discontinuity study a lot weaker and a lot harder. It has limits. You're absolutely right. Any other questions? Okay. So now I'm going to ask whether existing published structural papers address the above collection of issues. The omitted forces, the econometric challenges, all of this. And if they do not address it, do you consider these omissions problematic, or do you consider them forgivable? And you can make up your own mind to this. Okay, name me one structural model in corporate finance and beyond that predicts well out of sample. Let me go back. The whole point of the Lucas critique was reduced form models are very poor because they cannot predict in the future as we have particular structural changes underlying. It's the structural models, therefore, that predict better out of sample. It's still positive economics in Friedman's, right? What Lucas argues, although they never do it afterwards, the people who do structural estimations, our models are better out of sample because they are more stable than your shit reduced form models. But ask yourself, how many structural models do you actually see that do out-of-sample forecasting? And the answer is virtually none. Because if you read the Lucas critique right, whether he reads it like this or not, it doesn't say you need structural models. It says you need the right structural model. Just having a structural model by itself is not enough. And I would argue that I don't know any non-derivatives-based structural models which predict well and which are the right structural models. So, name me one structural model in corporate finance and beyond that predicts well in a quasi-experiment. Doesn't exist. And let me say that, okay, so when I sit in a corporate finance seminar these days, we argue, that's a purely empirical paper. We argue a lot now about whether X is really exogenous, how well identified it is. When it comes to structural models or more tech models, somehow we get so bamboozled, we forget about asking. We forget about asking, is X really exogenous? What evidence have you shown me that this is really exogenous? Okay, and in some sense, what I'm trying to argue here in this paper is, let's put structural models to the same test that we put reduced form models to. That is, you got to convince me that it actually works when you have a quasi-exogenous shock. Okay. So absent better models, I don't have anyone. I'm going to take some shots, pot shots at the best models. I will pick two of the most prominent ones. It's not about these two models. It's about the approach more general. Intelligent people can. I have to get to the next one. So specific models critique does not mean that future models couldn't do better. We can disagree. Intelligent people can disagree. I don't think they're going to, but if you can, great. If you want to see my critique as being somewhat constructive, you can say, well, I'm going to try and point out where these models should become better. Okay, so preview of my points. This is all that you should take away if you don't remember anything else. These structural models typically ignore too many plausible forces based on the priors on which their models are built. There's a huge gap between observable model and measured variables that they usually show you. I'm going to show you a little bit about how many models map into the same reduced form evidence. And you can't even say what we usually do in reduced form models. Well, assuming everything else is orthogonal. That's actually not enough for structural models. Even if everything is orthogonal, it will still impact your inference. Okay, I'm going to describe that soon. And we ignored all the econometric issues we worried about, and they are not held to the same high standards. There's no quasi-experimental or no out-of-sample evidence that I've seen to date, ever. Okay. Big structural break. Any questions so far? The other thing that I need to say is before I go tear into them, these models were great attempts at the time. Okay, they're very good papers. In particular, when they came out, it was really worthwhile to try following this approach. What I'm trying to say is, with the benefit of hindsight, 10 years later, I don't think this is that productive. So it's perhaps about where we should be in the future. So what is it that we first teach our students? So when you first go into class, talk about capital structure, you probably do the same thing everybody does. Well, no. First thing is Modigliani-Miller, and then afterwards you basically say, well, but let's presume there's some cost to debt and cost to equity. The cost to debt is that you're more likely to go bankrupt and you get some friction costs. And the cost to equity is that you lose the tax deductibility of interest, right? That's what we all teach. It's the first thing that we teach in corporate finance. It's been our basic workhorse. There's another paper by Fischer, Heinkel, Zechner, which basically says, well, if it costs you a lot of money to change your capital structure, so to issue equity or issue debt, you're not going to change it every time that your optimal capital structure should be something else. And because we all know that these models have very flat surfaces, there can be a wide range in which your capital structure is before you actually decide to adjust this. In macro, they call these things SS models. This is a very clever name because they have a little s and a big S. Okay, and the Stribulaev paper basically points out, it has some very nice intuitive points, which I'm not going to discuss in detail, but he was the first to point this out. They could have been pointed out here as well, but he uses his model to do that. But the hallmark is its quantitative dynamics. It takes exactly the tax distress model with frictions and puts it into a quantitative structure. Okay? There's nothing else in these models. Taxes, distress, frictions of adjusting. That's it. Okay, so you teach it already. You know this model. But he brings the heavy artillery. You may not do this in your paper. I do in your class. I don't do it either. But we're going to shoot with cannons here. These are the variables that are in his models. Okay, so we've got 23 variables, everything from the partial loss offset boundary to the proportional restructuring cost, QA, sigma, B. Okay, so there's a lot of variables in there. But with those, you can actually pin down exactly what it should be. This is the optimization problem. Now, I would love to show you the solutions to this, but there are no solutions. This is the model. Okay, we end right at this point. It's very hard to solve, by the way, numerically. Because there are these boundaries and it's flat functions, it's a nightmare. But, so if you want to do comparative statics and you want to know a simple answer to, well, if taxes go up, what happens to the capital structure? This ain't the model. Okay, you can answer that a lot easier elsewhere. But what this model can do that the other models cannot do, it can give you an exact numerical prediction of what the capital structure should be. So in in reduced form models, what we usually can only do is we can look at comparative statics. X goes up, leverage goes up. If we have something where X goes up under some parameters, capital structure goes up, and under other capital structure it goes down, we cannot test this with reduced form. At least not very easily. In this approach, that's right in the model. So it gives you huge advantages. If the quantitative prediction works, it's better. So it would be a great model if it predicts best. We don't care about whether the algebra is hard or not hard. Well, I do because I can't do it. But Stribulaev puts all eggs into one basket a priori, the tax distress friction models. The 15 other explanations that I showed you before are totally ignored. Is that a problem? I would argue it's a problem because I don't know whether these are the strongest factor, but that's what he does. Now, the model, tax distress frictions, this is aside from Stribulaev, this is any model. The frictions predict inertia. What is inertia? Inertia says that when you move away from your optimal amount of something, you're not going to adjust immediately back because it costs you too much money to adjust back. Okay, so that's inertia. That's not doing anything. And inertia means you don't adjust. But it's quite possible that you get non-adjustment without inertia. And let me show you how this basically works. This here, so this is time. This here is your leverage ratio. Here you have a target. Something shocks you to go down here. If you stay here without doing anything, that's inertia. Okay? Something shocks you, and you randomly flip a coin. If it goes up, you go up here. If it goes down, you go down here. That is not inertia. It's non-adjustment on average. On average, you don't move back up to your target. Clear? So a high variance here basically is evidence of non-adjustment. Inertia means that not only on average do you stay where you get put to, but your variance is roughly zero, or at least very small. Every once in a while, when you get far enough down here, then you're going to jump back right here. Okay, but it should happen very, very rarely. Clear? Okay, let's look at some of the data here. So Stribulaev has all his eggs in the tax distress friction basket. The problem is the basket has no bottom. Joke. So all evidence that you get from him, and actually from lots of papers in this literature that claim the evidence fits this model, is about non-adjustment. but I'm going to show you that there's a huge amount of activity. So what these models predict as the necessary reason for non-adjustment, which is inertia, is not there. First, to do this, I'm going to take the changes in your capital structure, DC, total. That's just your debt over capital ratio minus whatever it was last year. Okay? This is total capital structure change. Passive. This is what's going to happen if you are the CFO and you go for a vacation for 1 year to the Bahamas, someplace, Libya. Okay? You're out of touch. You can't do anything. You can't issue debt. You can't issue equity. Well, what's going to happen? So whatever your debt was before, whatever equity has before, but the X here is the rate of return on your stock. So if your stock doubles, you're going to have twice as much equity, and therefore your capital structure is going to go down. And then the difference between what happens with you being in the Bahamas and what you actually see is all the activity that you do. Okay? And for various reasons, which I'm not going to go into, this is actually a conservative version thereof, of what I'm going to do. So this here is your active capital structure. And what the tax distress friction theory says is that this should be small most of the time, and then every once in a while it should be really big when you're far enough away. Clear? There's nothing to say about this, very little to say about this, it's all in here. It's, as a manager, what do you do when your capital structure changes? Clear? Questions? Okay. So, the model that you get from Ilya is beautiful in that it actually tells me exactly what I should observe. I should see no change in DCA 17 out of 20 years, and in 3 out of 20 years, I should see 10 to 50% change. This is how it should look like. Okay? This is just a histogram of what's going on here. This here is DCA, so your active change of what you do, and it has its mean at 0, mode at 0. And what you should observe is that everything is clustered around 0. And in fact, it should be, 0 should begin down here. It should be about up there. And there should be nothing here. And then in 17 out of 20 years, you should see something here a little bit. And I'm going to zoom this out a little bit so you see it a little bit more. The fact is there is no hole here. There's no hole. There's a huge amount of activity, say at plus or minus 3% in your leverage ratio caused by managers. That's a huge amount, actually. Okay? So, yeah, it's more likely that you do 0, but it's marginally more likely than you do 2%. There's no qualitative difference here. So this is prima facie. Is that how you say it? Prima facie? Prima facie evidence against the hypothesis that managers mostly do nothing because it's too expensive to change capital structures. Managers change capital structures all the time. And by the way, this is net capital structure. So if I take short-term debt, I retire it, and I issue long-term debt, it doesn't even show up here. If that showed up here, this would be even higher. This would be much lower. And inertia basically says, you know, this can't be. This is just far off. Okay. Other things that are sort of interesting. I can compute, it doesn't matter whether you do it in panel or whether you do it pool, roughly speaking, what is the variance of this, of the active changes that managers do to capital ratio? What is what the stock returns do to you? And what is your overall change? And so what you should think about is, okay, stock returns push my leverage up or down. I respond with my leverage ratio activity. And as a result, I take whatever stock returns do and I push that back down. Okay, that basically means readjustment. Wherever stock returns throw me, they throw me from 10% to 30%. Now my activity on average push me back down. It turns out that's not the case. It turns out this here, if you take the variances, this and this are roughly orthogonal. They're roughly uncorrelated. What does that mean? That means that managers are not only incredibly active, they don't care in terms of their activity what happened to their firm's leverage ratio. So they're no more likely to issue more debt when their capital structure, because of great high stock returns, went from 30% to 10%, than when their capital structure goes from 30% to 50%. Right? That's bizarre, right? We would have hoped that what actually happens is, okay, if you believe in trade-off theory at least, okay, I was just kicked from 30% to 50%. Shit, I am now in danger of bankruptcy. What I want to do is I want to retire some debt and issue some equity. There are some theories that actually says why you wouldn't do this, but for sure it's the opposite of the trade-off theory. The trade-off theory says exactly the opposite. Now, let me make it really obvious. This here is your stock returns, where your stock returns are pushing you. This here is your total change in leverage. So this here is what happens if you're on vacation. You can actually break this out and decompose this. When you have very high stock returns, 200%, it's going to push your change in capital structure is going to be negative. Can be zero, by the way, because if you had no debt before, even if your equity price doubles, you still have zero. So it interacts with what you had before. So that is clearly a huge thing, and that's what I wrote in a paper of mine a couple of years ago, 6, 7 years ago. This here is the active capital structure. This is what happens to the log stock returns, how it pushes you up or how it pushes you down. This is what managers are doing. I've thinned it out a little bit. No, one is with dividends, one is without dividends. It's hard to see, but there's absolutely no correlation here. It's all over the place. So whatever your stock returns do seems to have nothing to do with what managers do. You can do this the following year. You're going to find a tight. So what you want to see here, if you want to get readjustment, you want to see this. Okay, we don't see this. If you do it the following year, it will look imperceptibly a little bit sloped like that. It'll be statistically significant. But the fact is it's going to be irrelevant in magnitude. So this is how I prune it out. That just makes it easier to see. I just randomly put some stuff. Okay. Managers do not readjust at all. Instead, their activities add to the volatility of leverage ratios. So if they are following a target, and if they are trying to meet a target, whatever the target may be, it ain't a slowly moving target. It's a weird thing. I don't know what it is. But there's no evidence that managers are trying to get back to whatever capital structure they were before. If this was a target, it must move mighty strangely. Okay? It must be that every time your stock return goes up, the target goes up exactly to the same place where it actually would have been otherwise. And that must be independent of what your previous leverage was. All tax distress friction theories fail, not just Ilya's model. They all have no predictive power. They're beautiful models, but they do not explain why managers are doing what they're doing. And there's clearly something going in their mind. They do stuff all the time. They don't sit around and don't do anything. They're thinking they're doing something. It's just that we don't know why they do what they do. So, what I wanted to show you is the following. This was my plan when I wrote this paper. I'm going to show you how these models predict great in sample. Then I'm going to show you they don't do very well out of sample. Then I was going to show you they fail totally in quasi-experimental tests, say when the tax rate changes. I got stuck at first base. They don't even predict in sample. They don't. These models, all that they've ever shown you was non-adjustment. And the problem is we've got inertia. We don't have inertia. We got non-adjustment, but not inertia. So I got stuck on first base. I can't tell you much about the in-sample performance, out-of-sample performance, or quasi-experimental performance. These models don't predict anything. They don't. And by the way, this doesn't mean that we can't publish a paper that says the t-statistic is 3. Yes, maybe on the margin it's an epsilon. But overall, as a profession, I think we're fairly clueless about the principal primary motives that make managers change capital structure. It's the big picture we're missing, okay? Not the marginal little t statistic. Deep structure model.
I'm sorry.
Yes.
Just an aside here. Did you actually ask some of the managers?
There is. Okay, I'm going to pound my own chest for a moment. I did one of the first surveys that was published in a top journal, which was my survey of equity premium by finance professors, right? It's probably the shittiest paper around, so that's the reason why I had to bring this up. It was just a terribly done survey. Fortunately, Cam Harvey and John Graham did much, much better work than I could ever do. They asked some managers and asked them, what do you think it is? And they say, we care about a target. They say, they just don't do. So what we really need to do, and I've been beseeching, every time I see John and Cam, I go on my knees and I beg. And what I say is, guys, we really need a paper that isn't anonymous, which is where you go and you ask the CEOs and CFOs, what are your motives? Where do you want your capital structure to be? Then you follow it for a year, you see what actually happens, and then you go back to them and you say, well, you said you wanted to have a 20% capital structure, and look, you went from 30 to 40%. What happened? I think this is what we need. In capital structure, if we want to learn what really drives managers, we need to understand what drives these guys. And I think you're absolutely right. We have to ask them. And but we also have to follow up with what they actually are doing, because what they say and what they do seem to be totally different things. Yes?
Do you have any clue that whether there is any causality from our lectures in the university and they thinking there is a target? So if we ask the same question 50 years ago where there was no MBA, were they still thinking on target?
I leave that to you. What Cam and John are doing sometimes is they try to ask them, do you have an MBA? And then they try and classify it according to whether they have an MBA. I think so. Well, actually, I don't know for leverage. I know that there's a relationship that lots of these MBAs are using the CAPEC. Is that a good thing or a bad? Okay, I am more advertising and commercial. So I wrote a book which I now only again which I'm going to distribute very cheaply. And the reason that got me to write this book is I went to my students that were final year MBA students, and I asked them the following question. Not bad. First, I asked them, look, Boston Celtics bond has 8% interest rate, the Treasury is 4%. Tell me why. And I swear, 80% of these students wrote down the capital asset pricing. 80%. Okay? This difference is explained to stick in. Has nothing to do with any of this. It would be better if they had never taken an MBA, because then they would have thought, maybe I don't get all the money back from the Boston Celtics. Maybe this is just, the average. The risk premium is tiny. Out of this 5% difference that it was at the time, maybe that was 20 basis points. If the CAPM were right, which is not, which is another issue. Okay, but so I'm not so sure that what we're teaching MBA students is a good thing. It's depressing. So leverage ratio, I don't know what they get taught and what they do afterwards. I leave that to you.
There you can do somebody randomly deny MBA entrance.
That's what we should do. Yeah, we need the discontinuities. We randomly reject MBA students. Then we take those which actually make it to CEO afterwards. We adjust for the selection bias. That you need an MBA to become a CFO in some companies, and then we actually see what they do. By the way, if you are a junior professor or PhD student looking for a job, please don't do that. Joke. Okay, I'm going to talk about structural models, and this is really somewhat important. I hope this is not. I'm trying to illustrate this in an intuitive way. So let's presume you have an unobserved variable R, R stands for the right variable, the correct variable. And you have a measured variable M. So what these structural theories usually are doing is they're inverting a behavioral theory. So for example, we got a theory that says your cost of capital influences whether you take more debt or less debt. Okay? And you can take two approaches. One is you can go out in the market and you can actually measure what is my cost of capital at the moment. That is, currently debt has a credit risk of X, Y, and Z, and that's the number which I want to use for this model. Another approach is you can have a structural model that says the CAPM governs how these things are priced. You take the estimate from the structural models as your cost of capital, and then you ask, how does that correlate with firms' leverage ratios? And that alone should tell you right away, well, that's probably a pretty lousy way to do things, because to the extent that your behavioral model, which here's the CAPM, is wrong, okay, we're going to have a lousy test of my actual model, which says the cost of capital influences my leverage ratio. Okay? But that's more or less what structural models do. They have an underlying behavioral theory which comes up with measured proxies, and then we relate measured proxies 1 to measured proxy 2. So, for example, you may have a theory which says that if you have a lot of productivity shocks, then you might want to have more equity. Okay, so there's two ways you can test this. One way is you go out and you measure the actual productivity shocks, or how likely you are to be exposed to productivity shocks. The other one is you write down a theory of productivity shocks that has implications for another variables like your cash holdings. And then what you do is you take the cash holdings, you invert it back into, if you believe that your theory perfectly explains this, you take the cash holdings, invert it back to productivity, and map that back into leverage ratios. That gives you essentially a relation between cash holdings and leverage ratios. And your structural model below, which has unobserved variables, holds this together. Okay? That's how most of these models work. This is also how most of the equity asset pricing models work. So you've got a theory of habit formation. Okay? So basically we have an underlying habit that's not observed that says something about different variables. We're going to take the relation between these different variables, and if it works, we're going to declare victory for our theory. But note, if cash is driven by something else, which has nothing to do with productivity, you're going to declare victory potentially for no good reason. Or failure for no good reason. These are really, really poor tests. Okay. So, cost of structure. If you impose structure, here's what you actually take into account. You've got a right variable and a wrong variable, and you've got a dependent variable. You've got a variable Q, which is the sum of R and W, and Q is observed. And R is independent of W. So W is the wrong variable, R is the right variable. Okay? So the true model says Y, average, is driven by your right variable, but you falsely believe that it's W that drives it. Okay? The number of colds that my 3-year-old child has. Not a good example. Okay, if W is observable, that is, you can actually get W. You run a regression of your behaved variable on W. W is independent of R by assumptions, right? It's uncorrelated. What do you expect B to be? 0. Okay, so you actually get a pretty good test. Now, if W is unobservable, it's a structural variable. Okay? But Q is still observable. And I'm going to presume that you know the correct structural form. That is, you know that Q is R plus W. So there isn't even uncertainty about your theory here. So Q is R plus W. You're going to run the observed variable Y on the observed variable Q. What's your expected value of B? Okay, somebody in the back. The gentleman with the eyeglasses. No, that one over there. Yes. What is B? Positive, negative, or 0? positive, okay? Because Q is, of course, R plus W. What are you going to do next? You're going to declare victory. My theory has support in the data. Okay, my structural theory predicted a relationship between Q and Y, and I've observed it. But note, R and W were uncorrelated. So it's not enough to say that holding everything constant or assuming other factors are uncorrelated or orthogonal. That only works for reduced form stuff. Okay? That only works for variables you throw in this regression. It does not work for underlying structural unobserved variables. Okay? So when you hear ceteris paribus, holding everything else equal, that means something very, very different for a structural model than it means for a reduced form model. For me, what I would argue is, look, first of all, if Q is very, very close to W or R, to W in particular, okay, this is a very good test. The more gap there can be between the variables that your theory is about and what you're proxying with, which is Q here, the further that distance is, the less believable your evidence becomes. Okay, and in this case, I had this particular gap, which was R. So what can you do? You can reduce the gap between R and Q, or between whatever you hypothesize it to. The analogy is you find a better instrument. And in my opinion, even if your proxy, and I'm going to go back to productivity shocks, even if your proxy for productivity stinks, okay, even if it's lousy, it's still better than using cash as a proxy for productivity, because your model says that productivity has an impact on cash. There's just too much daylight between cash and productivity to take that as a good measure back to productivity. So even if it's lousy, but if it's a direct measure proxy, it's still usually better than what you will get from a behavioral structural theory. You can increase the test stringency. So instead of being more lax, well, the model only needs to predict this, look at all moments, okay? Because you have such a huge gap already here. Be tougher. Enumerate your alternative explanation for Q, for cash in my example. If you can come up with 1,000 different other things that can have an impact on cash, don't believe what you find is good support for your theory. Okay, Hennessy-Whitehead. It's a tough theory to understand, very tough. It's very complex, it doesn't have closed form. But the forces are built on are very good, very plausible. Basically, what it has, roughly speaking, there's an underlying profitability, which is a structural variable, which they presume is not observed. Taxes also. And they determine capital structure dynamics and cash. How much cash you hold and how your capital structure evolves. And we're going to make it really easy on us. We're going to use their stated implications. They're not direct tests. They're more heuristic assessments of how important this particular theory can be. So, first thing. We highlight the main empirical implications. First, absent any invocation of market timing or adverse selection premia, the model generates, now pay attention, a negative relationship between leverage and lagged measures of liquidity. Consistent with the evidence, blah, blah, blah. Okay. Second, even though the model features single period of debt, leverage exhibit hysteresis. That's a really fancy word, isn't it? I use that too in some pretentious papers of mine. And that firms with high lag debt use more debt than otherwise identical firms. This is because firms with high lag debt are more likely to find themselves at the debt versus equity margin. So, let's take the first one, liquidity and leverage. Unobserved productivity drives liquidity and capital structure. And when Patrick discussed this at the AFA, he says, what does this actually say? When cash flows goes up, debt goes down. Let me repeat this. You make more money, your debt goes down. You know what? This is pretty hard to take as a great theory, as great evidence for a theory of productivity shocks. I mean, can you explain a model to me in which you get more money in and then you don't have less debt? Certainly on a year-to-year basis, this is pretty hard to come up with. So, and Patrick, of course, was a little bit selfish because he suggests that his own model is about cash balances and not cash flows. Okay, poor guy, so I followed his instructions. So we're going to put the cash flows down here and the active managerial behavior up here. So how much do you think cash flows actually impact active managerial behavior and capital structure? Now, and by the way, is this a great evidence for this particular theory? As I said, even if there's no productivity shocks whatsoever, the fact that you get more money in, your leverage ratio goes down, it's almost mechanic. You have to do a lot of things to undo this. So we have a t-statistic of minus 34, which is similar to the other stuff that was cited before. But shit, this is not a first order issue. So even if you believe cash flows are exogenous, okay, this is not the first order driver of what managers are actually doing when it comes to leverage activity. Lagged cash holdings. So this here is Patrick's theory. There, unfortunately, I can't even get a t-statistic, which with 15,000 observation is an accomplishment. Okay, virtually everything should have a t-statistic of pure value. It's just no relation. No matter how much cash holdings you have, that doesn't seem to impact what managers are doing. Contemporaneous cash changes. Maybe that makes a difference. No, not even that makes a difference. Okay, so I'm not even. Whatever it is, I'm not disputing that there is a relationship between cash holdings and leverage activities by managers. But we haven't found the big elephant in the room yet. That's not it. Yes?
Question in Tennessee Whitehead. And what you have here on the vertical axis is the active changes in leverage, whereas Tennessee Whitehead had the realized changes in leverage. It's not the same.
Yes, I know, but what comes about through this. And it turns out if I put in the DCT, you can take a quarter or half of whatever I've reported here, so the noise doubles. So it only gets worse. Second, even though the model features, we're almost done, single period debt, leverage exhibit hysteresis in that, now pay attention. Firms with high leg debt use more debt than otherwise identical firms. What's the alternative hypothesis to this statement? What's the opposite? It basically says that your debt ratio is IID. That is, you randomly draw a new debt ratio every period. That's the alternative. That's what we're going to find as evidence of the theory. Sorry, guys, this is not a test of a productivity theory, in my opinion. So the alternative here is that leverage ratios are random draws, which is idiotic. If you want to look at it, though, it's not. This here is the lagged debt capital ratio. This here is how managers are actually changing it. So there's lots of interesting things which aren't exactly model specific. So when you have a very high debt capital ratio, do you actually increase or decrease your leverage ratios with this answer? And the answer is actually there is a relationship here. A lot of it is survivorship bias, which I did not control here for, so it's not as strong as it suggests here. But even with that, it's not that strong. Even firms that have a 60 or 70% debt capital ratio very often increase their debt, not decrease their debt. There's theories why that happens, but okay. More stuff. What managers did before versus what manager did this year. So, is there hysteresis in what they are doing in terms of getting up their capital structure and getting it down again? The answer is no. So whatever they did last year has almost nothing to say about what they do this year. So there's a huge gap between the reduced and the underlying model. I don't find it plausible that nothing else drives cash, and certainly that they have the that nothing else drives capital structure. The fit is poor. It's not first order for capital structure. They might have a marginal. I didn't reject their model. Their model may be true, but it certainly is not very good at explaining something in the empirical data. Nothing about omitted plausible forces, econometric misspecifications, or quasi-experimental tests. Okay, almost done. This is how they conclude. Our theoretical and empirical results underline the importance of understanding corporate financial decisions in dynamic settings, as well as the importance of having a tight connection between theory and empirical work. Given the power of our theoretical and empirical framework to explain observed leverage phenomena, it appears likely that similar success is possible in other areas of corporate finance. God help us. And Stebolaev says, basically, let's combine their model with my model and then see whether we can do better. My assessment is a little bit different from theirs, as you might gather. There's too many ignored potential forces, too many ignored misspecification issues, and in particular, the test standards have been way too low. And if you asked me personally, now this is even more editorializing, it would have been a miracle if these models had worked. Now, is this an out of jail card? Don't many papers in corporate finance that are not structural and not quantitative share the same weaknesses? Absolutely. Absolutely. It's only the best papers in corporate finance. Many of them not been written yet, because I think we did have this quasi-experimental revolution right now that can be better. No paper is perfect, neither is this, but the best non-structural, non-quant papers right now, I think, are better than what we get from these models. The same issues hold true in asset pricing. They hold true in macroeconomics. They hold true in labor. The only place that I know where structural models work well is derivatives pricing model, and that's because arbitrage is holding them together. There we know the force. And then these models are great. Okay, conclusion. Current quantitative and deep structure models have failed empirically badly. What we currently have in terms of explanations remains a mystery, the first order effects. We really need to learn what is the big elephant in the room, maybe by asking these guys and then seeing what they're doing. And we really need a lot more quasi-experimental tests. And I have little hope that the structural models will make headway in this respect anytime soon. Now, almost done. Reader, keep perspective. A critique paper like mine is not unbiased. It's a whole lot easier for me to stand here and shoot down somebody else than to invent stuff myself. The papers were excellent. They were very worthwhile attempts. What I'm arguing is going forward, maybe we should look at other things and should go different routes in the future. I should also say the authors are absolutely fantastic, scholars and gentlemen. So there's absolutely nothing personal here. They're just absolutely wonderful. Hopefully going forward, the more exciting stuff is the quasi-exogenous reduced from models. Okay.